Very good morning to all of you. So again, we are back with another early morning session on the next side of income, right? So what we all have covered PGPP. I hope you have good understanding of what PGPP is, and we also worked out problems in study material. Some problems how you will be tested in your examinations. So I think we have done some exercise in PGBP. So hope almost all of you would have refreshed on whatever we have discussed in PGBP, and I'm sure you will definitely do good in exams in that head. So similarly, we will also continue the next head of income on capital gain, right? So what you would have covered salary first, and then house property, and then PGBP. Now we will commence capital gain. After that, you have other sources. So those are the 5 heads of income. Why is this important? Because each of the income should be categorized in one of these 5 heads. So only then you get your total income. So that's what we are going to do in our current session. So capital gain, right? So when we started profit and gains from business or profession, we said that we will understand each of the terms, right? Profit and gains, and we understood the term business, we understood the term profession. So we understood each of these terms. What does this mean, and how does it matter as far as income tax is concerned? So we did discuss that, right? But when it comes to capital gain, same concept. So we wanted to understand what do you mean by capital gain, right? So capital gain is just very straightforward. Basically, a gain from capital receipt, of some income from capital receipt. So you are having a capital receipt out of which you are making some gain. So you are not taxing the capital receipt as it is. You are taxing the gain out of that capital receipt, right? So that's what you're actually calling by capital gain. So this capital gain, of course, when you say capital receipt, the word, when we say capital receipt, it must be from some capital asset, right? It must be some capital asset. Only then you can actually call it as a capital receipt. So once a capital receipt is from a capital asset, it will be categorized under this heads of income. So we'll understand the first concept of capital asset. So to know what is capital gain, we should first know what is capital asset. Only then we will know capital receipts from such assets will lead to your capital gain. So this is what we are going to discuss it about right now. So what exactly is capital asset? Okay, what exactly is capital asset? So as the word goes, it is property of any kind. When you say property, they are not restricting it to movable or immovable. They are just calling it property, which means it includes both movable property and immovable property. So both are concerned, right? So when you say property, you are trying to say that both are included, both your movable and immovable property held by an assessee. It must be held by an assessee, whether or not connected to his business or profession. So we are not talking about whether he is doing some business or not. So typically what they are trying to say is it could also include your personal assets where it does not belong to your business. So capital asset need not be for business alone. It could be for your personal purpose also. That's why they say it is whether or not connected with this business or profession. So that's how it is generally defined. Okay. Now, this is a base understanding of what capital gain is. As we all know, capital gain has been defined in a particular section. So what section would generally be defined? That is capital asset. What section generally capital asset could be defined? In the general section, which has most of the definition. So that is nothing but section 2. We have been discussing about this in PGBP also. Like there are several, almost in all the acts, in most of the acts, section 2 will be a definition section. So in section 2, most of the acts, in almost all the acts, it's not restricted to income tax alone. Generally, definitions are alphabetically defined. So it is from A to Z. Okay. So your capital gain comes in clause 14. Being C, it comes in the earlier number itself. So it's clause 14. So this talks about that any business or profession, it need not be connected with business or profession. It does not stop there. It goes on. So to define two more categories as capital asset. Whatever we saw first one is more of general. Okay. So we'll call it as general. Generally, what is a capital asset? So generally, a property of any kind, whether or not related to the business or profession of the assessee. That's what is a general definition. Now, another specific definition is exclusively for securities held by foreign institutional investor. Securities held by the foreign institutional investor. The point is, whenever a foreign institutional investor, okay, now the question comes, who is a foreign institutional investor, right? I always go by a mechanism. Split the words and understand the common language. Now we'll split the word. What does it say? It says foreign, which means we'll keep it as non-resident. So foreign, we'll generally keep it as a non-resident. Okay. Next, the word is institutional. So what do you think the word institutional could be? An organization, which means they are not individual. They are an organization. So the non-resident we are talking about is not an individual, it's an organization. And then we say investor. When do you call someone an investor? When someone has invested, right? So what do you now mean by foreign institutional investor? All those who think that you would not have understood this term without me explaining. Now just think yourself, you're just splitting this word, 3 words, foreign institutional investor. So it's a non-resident organization who was invested in securities, or basically foreign institutional investor. Or we can also put that a non-resident organization whose primary activity itself is investing. So they are called as foreign institutional investor. So when they invest into an entity in India, in some securities in India, when such securities are transferred or sold, so they are called capital assets. So such securities invested by foreign institutional investor. Why is there a separate classification? Or will securities not fall under property? And when you say held by an assessee, doesn't it already include all kind of persons, including these foreign institutional investors? Why do you need a specific thing? Generally, a transaction in capital gain could either be regarded as capital gain, or if that is your primary income, that is what you have been doing day in and day out, you could call it as business income also. Like every day, my entire primary source of income itself is trading in securities. Then my income is business or profession. It will be treated as business or profession and not under capital gain, correct? So to differentiate that, you say that when will it be called as a capital gain? When will it be called as a business? So it depends on the frequency of events, how often you do that, or what is your intention. So all that is what matters between to understand whether it is a revenue receipt or capital receipt. You would have studied that in the basics of income tax, right? The intention behind the particular transaction is what makes it revenue or capital. Now, when it comes to foreign institutional investor, income tax says don't differentiate. Need not go through whether it is revenue or capital and all. It is always a capital asset. For these persons. So that's what it means by your securities in accordance with SEBI regulation. That is listed securities. Invested by this foreign institutional investor. They call it as FII. So such securities are called as assets. Then a recent addition from last Finance Act, any ULIP. What is ULIP? Unit linked insurance policy. If the premium of such policy is more than 2.5 lakhs, which is on or after 1st February 2021, on which exemption under section 1010D does not apply. What is 1010D? It is about insurance policies. Now, whether you have understood this or not, we are going to move forward. Why? Because this ULIP is not covered in your intermediate. It is only for your final. So just for your understanding, there is another category which will be discussed in detail when you are doing final. So as far as intermediate, concerning your May 23 exams and for your inter exams, we are not going to discuss about ULIP because it's not required. Okay. Now, the next part is the exceptions. Now, we generally said property of any kind held by an assessee, whether or not related to the business or profession, it will be called as a capital asset in accordance with Section 2, Clause 14. We also said any securities held by a foreign institutional investor in accordance with SEBI regulations will be called as an what you call a capital asset, right? So even if it falls under one of this, it will still not be called as capital asset if we are going to cover it under certain things. Okay, we are going to cover it under certain things. So basically, what we are trying to talk about is the first exception is stock in trade. Why is stock in trade excluded? Why is stock in trade excluded? Because it is your regular business operation. So which means the point they're trying to tell you is, let's say building is a capital asset. Okay, building is a capital asset. But if I'm a real estate builder like DLF or someone, my building need not be my capital asset. It could also be my stock in trade, because my activity itself is building and selling. It's like I build property, I sell it. So my building becomes a stock in trade for some businesses who are involved in that business. So which means if it's a stock in trade, it should not be categorized as capital asset. Next is rural agriculture land. You would have already covered this in computing exempt income under agriculture. When do you categorize something as rural agriculture land? Depending upon the distance, right? It must be in rural. If not in rural, it must be within the vicinity of like less than 2 kilometers, 2 to 6 kilometers, 6 to 8 kilometers. Vaguely remember what you studied during your exempt income chapters. So there's a classification, right? When do you categorize something as a rural agriculture land? First thing is it is not in urban. So that's a straightforward definition. Next is, even if it is not in rural, it could still be called as rural agriculture land if it is within less than 2 kilometers, 2 to 6 kilometers, depending upon the population, right? 10,000, 1 lakh and 10 lakh population. So that's what is about the ratio. So if it falls as a rural agriculture land, then it's not an asset. It's not a capital asset. So when you have a rural agriculture land, even if you're selling it, you need not pay even 1 rupee tax, whatever the income you receive from. Next is bonds. Not all bonds, specific bonds. It's gold bonds or gold deposit bonds. Gold bonds or gold deposit bonds, or also some special bearer bonds. So these are types of bonds. I don't think we need to explain all those. These are the types of bonds which are basically not a capital asset, not a capital asset. We are talking about exceptions. And then coming to personal effects. Personal effects, they're specifically excluding personal effects. But what personal assets? Only movable. Only movable. They are not talking. So which means a residential property being immovable is still a capital asset. But whereas if it's a movable asset, what can be the movable assets as far as an individual is concerned? First thing that probably could come to your mind is what? It could be motor car, right? The vehicle, the car that you drive, the bikes that you drive. So they are called as movable assets. So which means they are not assets. Then it is not only by themselves, it could be held by assessee or family member. So whatever it is there. So movable assets held by the assessee or family member will not be considered. So there is an exception. Now, there is an exception to this exception. What? Exception to this exception, which means even if it is personal, it is still a capital asset. For what? These 5 assets. What are these 5 assets? Jewelry, archaeological collections, sculptures, drawings, and any other art form. So what are these? So jewelry, even if it is a personal asset, even if it is a movable asset, it is still a capital asset. Any archaeology asset. What is archaeology? Old historical monument or something where you have identified some asset out of it. So such assets, even if it is movable, it is still a capital asset. And sculptures, whatever sculptures that we are talking about, old sculptures or whatever it is, even if it is personal, it is a capital asset. And then your drawings. So when you say drawings, any art form, it will include not just drawings, any artwork, any other artwork will be considered as your capital asset. It is personal, but still capital. That's what we are trying to say. Exclusion. So we are having an exception in an exception. So the exception, we said stock in trade, rural agriculture land, bond, which is your gold bond, gold deposit bond, and special bearer bond. And you'll have to keep in mind, interest from such bond is also exempt under section 10, clause 15. And personal assets, which are movable, belonging to the assessee or the family member, is not capital asset. But there is an exception to that exception, which is jewelry, archaeology, your artwork, drawing or sculpture is a capital asset, even though it is personal. Clear? So this is the base understanding of capital asset. So now, once we have understood this capital asset, now we need to see what are the classifications there in capital asset. What are the classifications there in capital assets? So basically, capital asset is what you call. We said we have just defined it, right, in under section 2, clause 14. When you categorize this capital asset, they are categorizing into two categories. So one is short-term capital asset. Other is obviously what? When you say short, the other word will be long, right? So short-term capital asset has been defined under section 2, clause 42A. Okay, 2 clause 42A. What does it say? If an asset is held for more than 36 months, so which means 3 years, right? So more than 36 months, immediately preceding the date of its transfer. Immediately preceding the date of its transfer. So whenever you're selling, you will have to take, are you holding it more than 3 years or less than 3 years? So not more than 36 months. So remember the word, it is not more than 36 months, which means up to 36 months, it will be called as a short-term capital. So exactly after the 1 day after the 36th month, it will become a long-term capital asset. So that is what it is there. So less than or equal to. So the thing will be less than or equal to 3 years. So then it is called as short-term capital asset. But most of the income tax, whenever we are reading, we are seeing there are some exceptions, there are some additional explanations, right? So similarly, short-term capital asset also has exceptions. What exceptions? So generally it is 36. But it is 12 months in certain cases. What cases? Listed security, unit of equity oriented fund, or zero coupon bond. Okay. What is listed security? These days, I think all of you know, right? Whatever is listed in the stock exchange. Like recently, all of you would be buying in Zomato food for sure. All of you would be ordering food in Zomato, Swiggy. Zomato is a recently listed products, right? So similarly, another common company, Nykaa, right? Nykaa is a cosmetic company. It's a recent company. Shares of Nykaa was listed in stock exchange. So which means these are all now listed stock exchange. So now when someone sells a share in Zomato, we'll compare Zomato and Swiggy. When someone sells a share, who owns a share in Zomato sells, for them, the time limit to define short-term or long-term, it is 12 months. It is 12 months, not 36 months. But when it comes to Swiggy, it is 24 months because they are unlisted shares. So when it's a company like Zomato, it is 12 months, less than or equal to 12 months is what is short term. But when it comes to entities like Swiggy, if shares of Swiggy is being sold by one of the investors there, then it is a 24-month category. So it's less than or equal to 24 months. So short term or long term is decided based on a general condition of 36 months, but it changes to specific assets. What are they? Listed security is 12 months. Unlisted security is 24 months. You can remember Zomato, Swiggy, if you think it's a very good example. Zomato is a listed. So if it is something like Zomato, then it is less than or equal to 12 months. If it's something like Swiggy, then it is less than or equal to 24 months. Okay, next is unit of equity oriented fund. What is equity oriented fund? It is a mutual fund. It is a mutual fund which entirely invests in equities. So that funds, equity oriented fund or unit of UTI, that is Unit Trust of India, for them also it is less than or equal to 12 months. Then zero coupon bond. So zero coupon bond is also categorized into 12 months. So all these assets are less than or equal to 12 months is short term. Above that will be long term. Whereas unlisted securities and land or building or both, for them it is 24 months. So land alone or building, of course you can't sell building alone. Land alone or land and building both put together, then it is less than or equal to 24 months. Then finally 36 months for anything else which has not been covered here, it will be categorized under this month, right? So anything which is not covered here will automatically be categorized under 36 months. Clear? So that is how the period is what differentiates between short term and long term. So generally 36, we saw exceptions for 12 months, we saw exceptions for 24 months. Okay, now we need to understand long term capital asset. It's a very simple thing. Okay, what do you mean by long term capital asset? Is a very simple definition. If you see, it is 2 clause 29A. Okay, 229A, which defines capital asset which is not a short term capital asset. Can you ever have some simple definition like this? When you read this definition, what do you remember? What do you remember? Another definition, something like this. In PGBP, we said profession includes vocation. That's all the definition. They don't tell you what profession is. They tell you profession includes vocation, right? So similarly, long-term capital asset, the definition is very simple. Whatever is not short-term is long-term, which means if it is more than 36 months, one day after 36 months, one day after 12th month, one day after 24th month becomes long-term. Clear? So that's what it is about. So even if it is one day above that, whatever has been defined under 2 clause 42A will be called as long-term capital asset, right? So that is the basic definition. Now, we immediately say that it is preceding the date of its transfer, right? So similarly, if the sale date is today, what date is today? 26th November. So if sale date is today, that is 26th November 22, you will have to take 3 days, 36 months prior, right? So you'll have to go back in time for 3 years and probably call it as what? 27 November 2019, if I'm right. So we'll call this, okay? That's what you're actually calling by 36 months. So 27/11/19. So if you have purchased it before 27th November 2019, it becomes a long-term asset. If you have purchased on or after 27th November 2019, it becomes a short-term capital asset. Correct? So that's what you define. Now, while calculating this period, there are some exceptions. So there are some exceptions to this calculation of period. What are those exceptions? When you say exceptions, there is some different methodology to calculate days for certain type of transactions. The first is, if the shares, be it listed or unlisted, if shares are held in a company in liquidation. What is liquidation? Liquidate, which means you dissolve. Okay, you are in the process of dissolving the company. So in that case, exclude the period subsequent to the date. So we need to exclude. Okay, we need to exclude what date? From the date company goes into liquidation. So you'll have to exclude the date subsequent. So if the date in which it went into liquidation is 1 year before, you'll have to stop that date. So your actual date of transfer, as discussed here, it is as discussed in this case, date of transfer, the date will be the date in which company went to liquidation. So any period after that date needs to be ignored. So you're not waiting for the last date in which your share was transferred. Your actual transfer date will be the date in which company went into liquidation. So that will be the actual date. So that's the liquidation. And assets in virtue of section 49 clause 1. What is that? Is basically it has come to you through gift, will, succession, inheritance. So you have got the asset currently, but it is actually not what you bought. It is previously held by someone. It could be your father, grandfather. You have got this property through some heritage, some or succession. Next person has been taking over. So if this is what it is, then the simple concept is include the period of previous owner. So which means if you are not actually buying the asset, it has come to you through one of this mechanism, gift, will, succession or something like that, then the date of the period from which the date of acquisition, okay, the date in which it was acquired is not the date in which it came to you, but the date which was purchased by the previous owner. So in case if my father is the one who's giving my property, if my father has purchased that property in 1990, the relevant date for calculation of short term or long term is 1990, not the date it actually came to me. Please understand. So that's the one thing. This line is very important because if you understand this logic, you're going to understand the rest of the clauses. If you understand this one clause logic, include the period of previous owner, please understand, you are going to understand the rest of the thing. Finally, I'll tell you one short trick to remember the entire clauses what we are discussing here after going through one by one. Okay. The next is asset converted to capital asset. So there is a conversion from capital asset from stock. So now what? From stock is what? So you did not purchase. Again, you did not purchase, but you have just changed the model. Earlier it was your closing stock. Currently now it has become your capital asset. So what is the actual purchase date becomes? It becomes date of its conversion. So the date in which it got converted, is what is the relevant date for calculating period of holding. So when an asset, when an inventory, when a stock in trade is converted into capital asset, the conversion date is the cost of the base date for which you need to calculate period of holding. Okay. Shares in amalgamated company in lieu of amalgamating company. What is amalgamation? When one or two companies join together to form one organization. So when moment a new company is formed through amalgamation, you should include the old period held in amalgamating company. So whatever period it was being held, it was being held in the previous company. So for simple example, if you want to say that earlier it was there was a company called A Limited, and what happens is now there is a company called B Limited. Okay, now this A and B has amalgamated to AB Limited. So when you are taking period of ownership, you will have to include from this. So that's what you are meaning by period held in amalgamating company. It's something like what? This. Include the period of previous owner. So you're not going to take AB Private Limited's holding alone. You're also going to consider A Limited's. If you're a shareholder of A Limited who is now a shareholder of AB Limited, you should include the period from the date you actually purchased A Limited. So that's what. So include the period of amalgamating company. Financial assets subscribed by the person on the basis of right to subscribe. So there's something like right purchase, right? Include person on whom right is renounced also. So it also includes person on whom right is renounced, which means someone has given up the rights. So period from the allotment of date. So the date in which such allotment was actually given is what needs to be given. So financial asset by person of right to subscribe. So you ignore the right to subscribe date. The actual date in which the share was allotted to you is only relevant, not the date in which rights was provided to you. So for calculate from the period of the allotment date of such share or security. That's for the right share. Next, right to subscribe any financial honor renounced in favor of any person. Period from the offer date. So when something is renounced, that you're giving up the right, the date from which you have actually offered till the date you renounced it. So that will become the period. So renounced is the period. So this right ownership, if it is allotted, you take from the period of allotment. If it is renounced, it is still there. If the right to subscribe is renounced from any other person, then you will have to actually calculate till the date of renouncing. Okay. So that's about it. Moving on, any financial asset allotted without any payment, that is like bonus. So what is relevant is the allotment date. Shares in resulting company from a demerger. What is demerger? Now let's say there is a company AB. This becomes A and B. So that is demerger. Okay. So this process is amalgamation. This process is demerger. So if there is something happening in demerger, you will finally end up with a resulting company. For example, in this case, A is a resulting company, B is a resulting company. So now shares in resulting company from a demerger. So include the period for which the shares are held in demerged company. You should not just include resulting company, also the period of demerged company. Something like what? Include the period of previous owner. So that's the same thing. Here in this case, it is the previous organization, previous mode or previous organization, whatever it is. Conversion of preference share into equity share. Again, when you convert preference to equity, the original holding period starts from the period preference shares are held by the assessee. previous owner. So I'll just put it in short, the trick I was saying. So previous owner, previous mode. So when there is a change in mode of an asset or change in ownership of an asset, you should always include the previous ownership. You should always include the previous ownership. So here, preference share is converting into equity share, right here. But here it is demerger and resulting company. Earlier we said amalgamation. Everywhere you'll have to consider the base. So when it was preference share, so can calculate period from the date it was held as preference share. So that's what it is. Whereas specified or sweat equity share, period from the date of allotment. So if you see, whenever there is a right share or bonus share or sweat equity share, the period of allotment is what is actually relevant and not any other date. So that's what it is about. And conversion of bond or debenture. So bond or debenture is converted into shares or debenture. So bond, debenture, deposit certificates in any form are converted into shares or debenture. We need to include the original period in which it was held as a bond. So that needs to be included. Okay. Here this clause was only about shares, but a couple of years before, even debentures was included. So now it could be converted into shares or debentures. Bonds or debenture stock or deposit certificates being converted from that form to what? To debenture. So that's what this provision is all about. So now, what period we are including? We are including the period in which it was actually held as bond or your debenture. So the concept is, for every transfer, if there is a previous owner or previous mode, include that period. So that's what it is about. So previous owner, previous type of organization, whatever it is. Similarly, when you say previous mode, earlier held as preference share, earlier held as bond, earlier held as debenture. All this when converted, we need to include that period also. Apart from that, whenever it is bonus, ESOP, or rights, the relevant period must be from allotment date. So we need to include from allotment date. So these are the only two categories which you need to keep in mind while calculating the period of holding. So whether it was held by a previous owner, whether it was held in some other form, okay, previous mode, or you can even call this form, previous form, earlier preference shares, earlier bond. So previous form, then include that period also. Similarly, if it is where you are not paying anything or some way of allotment, such as bonus, ESOP, or rights to share, then the allotment date is what is relevant. Okay, so that is all about your what you call capital asset and period of holding. Abdul is Goldman Sachs FII. Goldman Sachs as an independent entity in India also. Let's not get into a specific organization name. But yeah, if they're specifically into investment, they are investors. Generally, Goldman Sachs is more of a financial advisor company. So I'm not getting into specific whether they are FII or not. But generally, if someone's primary activities itself is investing, and they do nothing else beyond that, then probably they'll be called as a foreign institution. It's a status provided by RBI. So they'll have to be called as a foreign institutional investor based on the guideline provided by RBI. So that's what it is about. Abdul, I think you have referred an example called plant. Is it for movable asset? Yeah. So plant could be a movable asset. Dhyanesh, public company definition. See, public company is basically what? A company in which public has, in which at least 51% of shareholding is held by a public. So it's not by private shareholders. So when it comes to private limited, it is held by closely connected people. But when it comes to public company, the shares could be held by anyone. There is no restriction on who should held on to the shares. Anyone can have. So that's what public company is about. So when you say public company, shares can be held by people outside the known community also. That's what it is about. Okay, with that, we have completed what is the definition of capital asset, categorization of capital asset, and we have also discussed about how do you compute period of holding in certain situations. For that, we gave a small what you call tip, kind of pro tip. What is it? If it is previous ownership or previous form, include that also. If it is something like share allotment through not regular purchase, something like bonus, rights, or ESOP, the date relevant is the allotment date. So that's what it is about. Okay. So now we'll move on to the next concept. We now know there is a capital asset. Okay. Now we'll just understand this. Okay. We have a capital asset. But when does it become a capital gain? When does it become a capital gain? So how is this? There is a capital asset. When does it become a capital gain? It happens when there is a transfer. So when a capital asset is transferred, you make capital gain out of it. When a capital asset is transferred, you make capital gain out of it. So we need to understand this term. What do you mean by transfer? So that's what we are going to understand right now. So what exactly is transfer? Transfer is defined under section 2 clause 47. Okay. The definition is inclusive and includes the following types. Sale, exchange, relinquishment of assets. So either I'm selling an asset or I'm exchanging an asset or I'm relinquishment of asset, which means I'm giving up the ownership. So that is what is relinquishment. So I'm not holding it to any more to that asset. Similarly, extinguishment of any rights, not just holding to the asset, even any rights that I have to that asset. So I'm giving up that also. So I'm writing a proper agreement and saying this is no more my asset. You please take care of it. So extinguishment of rights is also a transfer. So when you feel that you have given up the right and will no more come back to us, it will never come back to us. So it is something is called as extinguishment of any rights therein. Then compulsory acquisition thereby any law. So this sale or whatever is happening need not be volunteer. It could be compulsory also when law wants to. Across India, you might be seeing that there are metro constructions happening in various parts of India. So to construct metro, what should government do? They can't use only the land that they own. They obviously need private lands. So they will go and tell that owner, see, I need your land for metro construction. You will have to give me whatever is the market rate at this point in time and this particular locality. I'll give money to you. So this concept is called compulsory acquisition. You don't have an option. You only have to give. You can't go and fight anywhere. You will have to give your property. So that is compulsory acquisition. Then conversion or treatment of capital asset into stock in trade. So there is a capital asset, you're converting into stock in trade. So then that conversion, how do you treat it? So this is also a transfer. So then maturity redemption of a zero coupon bond. In that case, the whatever is the period, the maturity, whenever it is being redeemed, the zero coupon bond being maturing or redeemed, that will be the period in which it is being considered as transfer. Similarly, any transaction involving allowing a possession to be taken remained on part performance of a contract. So what do you mean by part performance? One of the examples that you can talk about part performance is like this joint development agreement. We'll see that in subsequent slide also. When you have a land and you decided to give it to a builder and the builder builds that property, you don't get money at once. You get it at stages. You get money at stages. So it's something like part performance. It's not full. It is completely sold and you get the money. It is sold one by one and finally you get the money, overall money at later point in time. So the part performance contract is also transfer. So moment you enter into a contract, which is something like part performance, you need to pay. It will be considered as a transfer. Similarly, transferring, which enables enjoyment of any immovable property. So I'm actually not selling and all, but I'm giving the rights to someone to use the property alone. So I say that I'll no more use this property, you entirely use this property. So now indirectly I'm transferring, I'm not actually selling it, but I'm letting someone use my property forever. That could also be called as transfer. So typically if you see any form of movement from one person to another person by means of sale, by means of giving rights, whatever mode it is, it will be called as transfer. So it is so wide, right? If you actually see definition, is so wide that almost anything and everything, when it moves from one person to another person, not the property ownership, even the rights, not the ownership, even the rights, not voluntary, even it could be like forced also. So it need not be a voluntary transfer, it could be a forced transfer also. So all this is what we are actually calling it as a transfer. So that is being defined in section 2, clause 24, correct? So that's what we are actually discussing here as saying about what will be a transfer. Now again, when we talk about this transfer, immediately we should know that there will be what? There will be exceptions to this concept of transfer. So what are those exceptions? So moment we say transfer, some of them will not be considered a transfer, even if it is generally falls under the definition of transfer. So transfer was defined in section 2, clause 47, correct? Section 2, clause 47. And not a transfer is section 47. Remember the coincidence? So the coincidence is section 2, clause 47 defines what is a transfer. Section 47 defines not a transfer. So there is a immediate mapping between the section. You need not remember two section numbers. If you remember one, you automatically will remember the other one. If you remember that section 2, clause 47 is the definition of transfer, you immediately will know that section 47 is the section which talks about which are not a transfer. Okay. Those who are just having steady material in hand and trying to follow me, I am skipping certain things and directly coming to a subsequent page number. The reason is, since we discussed about transfer, I want to discuss not a transfer immediately. That's why I'm skipping and going forward. And after this, I'll again come back. I'll come back to where in the page after that section 2, clause 47. So we understood what is a transfer. As we have understood what is transfer, immediately we are trying to understand what is not a transfer, so that there is no gap in between them. So what are they? So what is basically called as not a transfer? It is distribution of capital asset on the total or partial partition of Hindu undivided family. So there is an HUF, they are partitioning their asset. It is not a transfer. It is not a transfer. Why? It is something like held by previous owner coming to you through will, succession, or gift, something like that, right? So the partition of HUF is not a transfer. Again, transfer of capital asset under gift or will or irrevocable trust. So whatever is being from the thing, whatever is that is what called. And this provision is not applicable for shares, debentures, warrants allotted by a company directly or indirectly to its employee. So now we are talking about gift or irrevocable trust or something that kind, but this does not apply to company transferring shares to the employees of the company in a scheme of ESOP, that is employee stock option. So it's not covered. Okay. So that's an exception to generally gift, will, or succession is not a transfer, but that does not apply to ESOPs. Holding company to a wholly owned subsidiary company, which is an Indian company. Please remember, we are talking about a holding company. There is no specification whether a holding company should be Indian or should be outside India. But when a transfer is happening to an end party, the recipient must be an Indian company. So holding to wholly owned subsidiary. What do you mean by wholly owned subsidiary? 100% ownership. 100% ownership is what is called as wholly owned subsidiary. Now, in this 100%, if they have someone as control, any transfer between holding to this wholly owned subsidiary is not a transfer. Okay, that's the first thing. Second thing, wholly owned subsidiary is transferring to the holding company, the reverse. In that case also, it is not a transfer. In this case, also the recipient should be Indian. So the recipient here is a holding company. The recipient here is a holding company. So in short, transferred from a company to another company where the recipient is an Indian company. What is the relationship between them? Holding and wholly owned subsidiary. If this is the relationship, transfer between them to the resulting Indian company will not be treated as a transfer, correct? But this transfer will be withdrawn. This transfer in both these cases, it will be withdrawn. It will be withdrawn if they're converted into stock in trade. Such capital asset is converted into stock in trade. So that's what it is about. Similarly, capital gain that exempt, whatever was exempt earlier, because it was not a transfer, so capital gain would not have come. So in that case, whatever would have been the capital gain will be deemed to be the income. So what are they trying to say? They're saying that whatever would have been your capital gain in that year, had you actually calculated, treat that as an income now. Treat that as an income right now. So that's what we are actually calling by capital asset deemed to be an income. So now the next concept is transfer in a scheme of amalgamation. So when there are assets being transferred between amalgamation, in our example, what we saw, let's say if A Limited is transferring assets, then it is not a transfer. It is not a transfer. And similarly, transferring a scheme of similarly in demerger. In our earlier example, if A Limited is transferring to, okay, if AB is transferring to A in case of demerger, so that is also not a capital asset, so not a transfer. So that is why in these two and these things, the previous ownership is considered as the ownership. The date, for date calculation, if you remember, we said the previous owner's date is relevant. The reason is this, because the subsequent transfer is not a transfer. Subsequent transfer is not a transfer. Father, we are considering father's date of purchase of a property because the transfer between father and son is not a transfer. Same way, we are taking date of the amalgamating company because the date of the transfer between amalgamating and amalgamated company is not a transfer. Same for demerger. I think I've made it very clear on why. I'm stressing this why because it's a very important question. You need to understand why there is a provision. You understand the why, you will not forget. So this becomes very, very critical in remembering the provisions for longer period. We are not saying the provision, we are saying why there is a provision. I'm trying to link what we read in this exception to this period of holding, and I'm trying to link which is not a called a transfer. If you remember, father giving a gift to a son, a building, the period of holding commences from the date in which father acquired, not the son holding onto that property. Reason, because transfer between father and son is not a transfer, correct? Is not a transfer. That's why we're including that whole period. Same way applies to these amalgamation and demerger. The transfer is not considered a transfer. So at the time of ultimate transfer, you take the period of holding from this person and ignore this person. So that is why we are talking about why the provision is in place. The next thing, transfer of issue or shares of resulting company. Earlier we said assets, right? Properties of amalgamating and demerged company. Now we are saying shares by resulting company. So now the resulting company, that is in demerger, in our example, we said AB is becoming A and B. Now, when A is issuing shares, it will not be treated as transfer because the shares issued by A is because it was earlier holding shares in AB Limited. So let's say there was holding 100 shares in AB Limited. Now I'm going to get 100 shares in A Limited. This transfer is not a transfer. So that's what you mean by resulting company thing. So similarly, transfer in a scheme of amalgamation of shares held by a shareholder in the amalgamating company, that is also not included. Clear? So that is also something that is not generally concerned. Okay, so this transfer is also not there. Only thing in both these cases, they say that transfer is made in consideration of allotment to him any shares or shares in the amalgamated company, where shareholder itself is the amalgamated company. And the amalgamated is an Indian company. So basically, forget this Indian company, because everywhere we said the recipient company should be an Indian company. So that's what we are talking about. But the first point, which talks about shareholder itself, I'll try to explain about something like this. Let's say there is A Limited, okay, and A Limited is the 100% shareholder of B Limited. So A Limited owns 100% shares in B Limited. Now, what happens is B Limited merges. We'll call it as amalgamates. Okay, amalgamate. Nothing but merger. Now it becomes amalgamates and becomes AB Limited. Okay. Now, who's the shareholder of B Limited? The shareholder of B Limited is A Limited only. The shareholder of B Limited is A Limited only. Now, once it becomes AB Limited, A will still remain the shareholder of this, right? Whatever is holding in B now comes to A Limited itself. So, shareholder itself, they are issuing for themselves. They can't do that, right? So that's why they say. So this will not, if the transfer is made in consideration of the allotment of him any share or shares in the amalgamated company, except where the shareholder is not itself is the amalgamated company. So in this case, the shareholder A Limited only is now the amalgamated company. So now they cannot issue shares for themselves. So ignore that alone. Otherwise, everywhere when the share is being issued by this new amalgamated company, you need to not treat it as a transfer. And then transfer made outside India of a capital asset being rupee denominated bond. Okay, rupee denominated bond is a foreign asset which bonds issued outside India. We'll keep it this, okay? Bonds issued outside India by an Indian company. So an Indian company will issue bonds outside India. They are called as rupee denominated bond. So that bond, if it is transferred between non-resident to non-resident, so the asset itself is outside India, it is happening between two non-resident, then that is not a transfer. So this is also an exception. Similarly, transfer of capital asset being government security, a periodic payment of interest is made outside India through intermediary dealing in settlement of securities by non-resident to non-resident. So here also, it is a government security. It is being transferred from non-resident to non-resident. So these both is where it is happening between NRIs. Transfer of sovereign bond issued by Reserve Bank of India under a particular scheme. So now when it is being redeemed, it is not a transfer. So typically it is exempt. So sovereign gold bond by redemption is not a transfer. So even if it is a capital asset, such transfer is not considered as a transfer. Moving on, transfer of capital asset being work of art. We said even if it is personal, it is a capital asset, work of art, archaeological or any art collection, book, manuscript, drawing, painting, photograph or print. But to whom it is transferred? It is transferred to the government, or it is transferred to the university or museum or national museum. So if it is being transferred to one of these, national museum, national art gallery, national archives, or any such public museum or any institution which is notified by the central government, then it is not a transfer. So whatever archaeological or whatever assets we spoke about in personal, which will be considered as a capital asset, if that asset is transferred to government. For example, let's say in very old days, there are prior to even occupied by England, India was all king ruled, right? It was all ruled by kingdoms. Across country, it was ruled by different kingdoms. Over a period, British overtook and then India took up the government. Moment India took up the government, they gave up restrictions on various these kingdom families. So what they say is they took away the assets, the monuments, whatever they were holding on. Government took away most of them, saying that these are government assets. So what happened is most of these assets which are transferred to government, that is all this valuable art form, is not a transfer. So they were not taxed for such transfer. So that's what it means by transfer of capital asset of these specific assets. Conversion of bonds or debenture into shares or debenture. Remember why? Because that is why we are including the previous form into this. So this is also similar concept. Transfer by way of conversion of preference share into equity share. We saw that earlier in period of holding, include the period of holding of preference share. Why? Because the subsequent transfer from preference share to equity share is not a transfer. So this also falls under the same concept. Transfer of capital asset in case of a reverse mortgage scheme. What is mortgage? Mortgage is lending, right? Loaning. So now I keep my property. I have a building. I keep my property. I say to bank, see, I need loan, but I have my property as a security. So based on the value of my security, I want you to give me money based on that. So the bank will say, based on your property value, I'll give you 70%, 80%. So this is called mortgage, correct? Bank will give me loan. Now I start settling this money. The reverse mortgages, now bank will take back that from you and bank will start giving you money. Reverse mortgages, you start repaying bank. Now what if bank starts repaying you in something, some more money? So it's called reverse mortgage. So I keep that again and then I get back money. So under scheme made by the notified central government. So that's what you actually call it as reverse mortgage. So reverse mortgage is also something which is basically it's not a transfer. So though it is being again transferred, kept as a mortgage, it will still not be considered as a mortgage. So that's what it is about. Okay. So now with respect to these, so basically this reverse mortgage is only where government announces a scheme for reverse mortgage. So whenever you need additional amount for additional loan amount or something, you do another mortgage. So that is what you make it as reverse mortgage. So this reverse mortgage scheme, you get extra money. Through this reverse mortgage. So that thing is not called as a transfer. So that's what it is about. Okay. So it's only to get a source of additional fund. Okay. So this mortgage and other thing is not called as your capital asset, capital transfer. That's what it is about. Okay. So we have covered all the not a transfer. So whatever we discussed is not a transfer. So section 2, clause 47 talks about transfer. Section 47 talks about transactions that are actually not called as a transfer. If you see, most of them are already discussed in the period of holding also, like preferential equity, bonds to shares or debentures. So all those is already discussed in period of holding itself. Most of them, what was discussed there is repeated in this not a transfer section. So that's what it is about. Only few things like your reverse mortgage, your rupee denominated bond are only the things that are new, which are discussed here. Okay. So we'll start with understanding some of the problems. So basically, ML'd 2000 shares in a company of ABC Limited, an Indian company. Okay, they're saying that he was holding on to a company called ABC Limited, which is an Indian company. This company amalgamated with another Indian company, XYZ Limited, during the previous year, ending 31st March 2023. So now, under the scheme of amalgamation, M was allotted 1,000 shares in the new company. So he had 2,000 shares in ABC. Now he is being allotted 1,000 shares, correct? In the new company, the market value of shares allotted is higher by 50,000 than the value of holding in ABC Limited. Let's say if his value in ABC of the 2,000 shares is 10 lakhs. Now in this XYZ, the 1,000 shares, okay, the 1,000 shares itself is like what? Is higher by 50,000, than the value of holding in ABC Limited. So it's something like this itself is like 10,50,000. Okay. So now 1,000 shares in the new market, the market value of shares allotted is higher by 50,000. So he was earlier holding 10 lakhs of shares. Now he is going to hold 10,50,000 of shares. The question is, since there is an increase in money, should that be treated as a gain? The answer is what? The answer is straight no, because it is covered in the exception in transfers that we discussed. So we discussed that whenever there is a transfer of shares, transfer in a scheme of amalgamation of shares held by shareholder. So shareholders of amalgamating company getting shares of amalgamated company is perfectly fine. It is not a transfer. So that is what is discussed in this particular XYZ Limited. Okay. We'll move on to the next illustration. So illustration 5, it is basically in which of the following situations capital gain tax liability does not arise. So Mr. A purchased gold in 1970. The value of that gold in that day was 25,000 in gold in value. That was in previous year 2023 is gifting to his son at the time of marriage. The fair market value of the gold on the date of gift was 1 lakh. This is 1 lakh. So it was 25,000. Now it is currently 1 lakh. What is the treatment? So as per whatever we discussed in section 47, transfer through gift or will or succession to a person is not a transfer. To a person is not a. So capital asset under gift is not regarded as transfer for the purpose of capital gain. So that's what is about it. Okay. A house property purchased by Hindu undivided family in 1945 for 20,000. Today they are actually partitioning it and giving across it. On the date of partition, the FM value is 12,000. We said some words are relevant, some words are not relevant in a question. If you actually read this, the entire line is irrelevant. Why? Because it doesn't matter what the fair market value. Moment you know the transaction, all you need to know is whether it is a transfer or not a transfer. So here it is partition of HUF. It can be partial partition or total partition, but any partition is actually not what? Is actually not a transfer under section 47. So that this is not treated as a transfer. So this will also be not regarded as a transfer. Mr. B purchased 50 convertible debentures for 40,000 in 1995, which are now converted into 500 shares of 85,000. Now 40 has become 85. Is that relevant? No. Is 50 debentures are now become 500 shares? Is that relevant? No. Why? Because it is subsequently, it is not a transfer. Now, if you remember in all these cases, what will be the cost subsequently considered in case of calculating capital gain, period of holding? Everything will be this, correct? So that is why we are actually ignoring. So since it is already been discussed that the period of holding is the period of holding from the date of the previous owner. Similarly, the cost of the asset, while discussing section 32, we discussed what will be the actual cost under section 43 clause 1. What did we say? We said it is nothing but when it is being building from a previous owner or any asset from a previous owner, we said that cost is what is relevant. So that is why we are saying it is 50 convertible debentures to 500 shares. It is not a transfer. So the point here is any conversion is not a transfer. Just that at the time of final transfer, the period of holding and the cost will be that of the previous owner or not the current owner. So that's what we need to do. Okay, we'll move on to another illustration, which is illustration 6. Here, Abhishek, a senior citizen, mortgage his residential house. So he is now mortgaged his residential house with the bank under notified reverse mortgage scheme. So now he is again mortgaging assets. So he already mortgaged it to the bank. He is again doing a reverse mortgage. So another additional mortgage. So here he was getting loan from a bank in monthly installments. So he is getting monthly loans from a bank. So he will be paid on a monthly basis. So he did not repay the loan on maturity and hence gave possession of the house to the bank. Now he is not able to repay this itself. So the bank is taking over the property from them because he is not able to pay. Now this treatment, is it a taxable or not taxable? Basically, we said reverse mortgage, any transfer of capital asset based on the reverse mortgage. If it is notified by the central government, it will not be a taxable transaction. In this case, basically whatever has been happened to Abhishek will not be regarded as a transfer. Why? Because it is a reverse mortgage. We said that it is a notified under reverse mortgage scheme. So it says it is notified under reverse mortgage scheme. Since it is a notified reverse mortgage scheme, it is not taxable. Similarly, whatever is being received from Abhishek as monthly installment is also exempt, because he is a senior citizen. So whatever he is receiving, not monthly, whatever he is receiving the loan, whatever he is receiving this loan from the bank, be it monthly, it could be monthly or it could be lump sum, whatever he is receiving as a loan in any form, month or lump sum, whatever form, will not be treated as an income under section 10 clause 43. So that's what it is about. So now both the transaction will not be treated as transfer. This will also not be treated as an income in the hands of Abhishek under section 1043. So that's what this is about. Clear? So we'll move on to the next illustration. So it's basically examine with reasons whether the following statement is true or false. So the first is alienation of a residential house in a transaction of reverse mortgage under a scheme made and notified to the central government. What is it? For the purpose of is treated as transfer. The question says it is treated as transfer. It is false, right? Because the property given under reverse mortgage is basically not a transfer in accordance with Income Tax Act. So it is false. So it will not be treated as a transfer. So that's the first thing. Next is zero coupon bonds of eligible corporation held for 14 months will be a long-term month. So it says 14 months. Zero coupon bonds will be a long-term if it is held more than or equal to more than 12 months. Okay, more than 12 months. So which means this will be true because it has been held for 14 months. Hence, yes, it is a long-term asset. Zero coupon bond means a bond on which no payment and benefits are received or receivable before maturity or redemption. It's actually true, but I think, I don't know whether you are explained about zero coupon bonds during exempt income explanation. So zero coupon bond is basically issued by certain organization, predominantly into the field of infrastructure. So these company issue bonds as a general public, we buy that bond. They do infrastructure developments based on the funds that they have received from. So we are giving our money through a bond for them to do that infrastructure work. For this, what happens is there is nothing on maturity or redemption. So whatever it is basically issued, there will be no additional benefit or something received at the end of the period. Whatever I issued is a bond. At the time of maturity or redemption, I get back the money. So now this is basically what zero coupon bond is. So zero coupon bond has no benefit or no benefit during maturity. So there is nothing happening during maturity or redemption. There is no additional benefit. Why? Because when you buy itself, let's say the bond value is 100, you buy it at discount. You buy it at discount of, let's say, 96 rupees. Instead of 100, you will pay 96. But when you receive, you will receive 100. So this 4 rupees is a discount that you pay at the time of purchase. At the while time of maturity or redemption, you don't receive anything, etc. Generally, like a fixed deposit or something, what happens? If you have deposited 100, when you receive, you get above, right? But here, the deposit value is 100 only, but you don't give them 100. You give them 95 or 96. But when you receive 100 itself. So that's what the zero coupon bond is. So at the time of maturity or redemption, you don't get any benefit. Why? Because you get benefit at the time of purchase. At the time of purchase, not at the time of maturity or redemption. So that's why it is called zero coupon bond. Okay. So that's all about section 47. We'll understand one small area of definition alone. That is, we need to understand what is an amalgamation, what is a demerger. Everywhere in the period of holding or not a transfer under section 47, we have been discussing about this concept of amalgamating company, amalgamated company, resulting company, demerged company, amalgamation, demerger. So we have been going through these concepts. Now we'll understand what exactly is amalgamation. In short, it merger of one or more companies with another company. So that's what it is. Merger of two or more companies to form one company. So either you merge with another company or two companies form together and become one company. In our example, when we said A Limited, B Limited together forms AB Limited. So two company together forming one company. That is, you're becoming one company. And whereas, let's say it is like here what we said, here we said A Limited, B Limited is amalgamating with the A Limited. So A Limited is the same entity, just that B is no part of A Limited. So this is also amalgamation. That's why we say one or more companies with another company, or two or more companies to form one company. So that's what it is about. But what is the requirement? What is the requirement during the amalgamation? All the properties and liability must become that of the amalgamated company. Amalgamated company should become the owner of this. All the properties and liabilities held by the amalgamating company. Similarly, shareholders not less than 75% in the amalgamating company become shareholders of amalgamated company. So almost three-fourth of the shareholders must be the new shareholders of the new company. They should not be left out. But if it is after winding up, that is during this process of liquidation, after winding up, if there is an amalgamation, then this is not classified. This is not applicable. So what is generally what we'll take an example. Okay. So what we are trying to say is, let's say A Limited. This A Limited will be called as we'll take the old example. So this A Limited is called as amalgamating. B is also amalgamating. This AB is called amalgamated. Future, right? Amalgamated. So now it's like past. So now it has happened. A is one company, B is one company. They are currently amalgamating. It's a process happening. AB is an amalgamated. So that's the end. So amalgamated has become an end. So that is why it's called as an amalgamated company. But when it comes to demerged company, resulting company, when it comes to demerger, they say that demerger means it's a split, okay? It's a split. So one entity is being split into a couple of entities. Now, all the properties and liabilities of that particular undertaking, that split undertaking, is what should become the assets and liabilities of the new company, new resulting company. So here, demerged company is the company which is being split. Resulting company is the company which is being formed out of the split. So whatever shares issued by the resulting company should be in the same proportion of the ownership in demerged company, and here also not less than 75% should get the shareholding. And transfer of an undertaking company is an ongoing concern, on a going concern basis. So which is basically, what is going concern? Go back to your 11th standard accounts and understand what is going concern. Going concern is the belief that you think the entity will survive forever. There is no end to the entity. So now this should be the concept. Now you cannot just split a particular entity because it is not doing good, is doing bad. You think that it will close off in a couple of years down the line. So you want to split it as a new company. That can never be the intention. So apart from this, there could be any other conditions provided by the government also. So all this is what makes an amalgamation. So if you see amalgamation, all the assets and liabilities are transferred. At least 3/4 of shareholders should continue to be the shareholder of the amalgamated company. Demerger is again one company splitting into multiple entities. Unit or undertaking of one organization is being split. Let's take an example. There is a company called C Limited. They have two business. Okay, they have two business. FMCG, another is hotel. So they run hotels. They also have a FMCG business. Okay. Now they make this FMCG as a separate company called as C Consumer Limited. And this hotel is being treated as C Hotel Limited. So now there is C Limited. C Limited has become two companies, C Consumer Limited, C Hotel Limited. So this is demerger. So this split is called as demerger. So now this will be called as a resulting company. Resulting company. And this is the demerged company. Demerged company. So this hotel business is become a new distinct business. They have changed the name to C Hotel Limited. This FMCG is a new business on its own. It's a new company on its own. So it's called C Consumer Limited. So this is called resulting company. So that is what it is there. Here also all the assets and liabilities should be transferred. And shares, not just 75%. There is an additional condition which says in the same proportion in which shares are held in the demerged company. So if someone was holding 25% in C Limited, they should get 25% in C Consumer Limited also. So that's what it is all about. Clear? Okay, with this, what we'll take a short break, 10-15 minute break, and then we'll continue with the rest of the capital gains chapters. So welcome back. So we will. I forgot to address questions this time, so I'll address some of the questions. So we'll see. Yeah, Dhyanesh. Yeah, okay. You have referred public company as being similar to this long-term asset definition. Very good. Yeah, public company says it's not a private company. So there are a few definitions like that, right? When you sell a capital asset, it's a profit. Yeah. Dhyanesh, if asset is given to NGO free of cost, then it's also transfer. It is a transfer. So transfer does not talk about whether you're receiving money or not. It only talks about whether you're relinquishing a right, whether you're giving up to someone, whether you're selling, or whether you're just giving the usage rights alone. So depending upon that only, the transfer is defined, not about receiving money. So free or with money is not okay. It doesn't matter. We'll see that later. Like how do you determine the sale consideration in certain situations? Some of you have asked, Nikita, Dhyanesh, and all have requested about what is the difference between merger, acquisition, and amalgamation. So basically, merger is like two entities becoming one single entity. Like one of you have spoken about this Vodafone V, Vashishta, as she said that Vodafone and V are becoming one single company, right? So they are merging. So they are merging as one single entity is typically called as merger. When you say amalgamate, typically, yeah, it is kind of thing, but here there is no requirement that a new entity should be formed. It could be like one company just joins with another company. One company just joins with another company. So amalgamation is typically will result in a completely new company, but merger is it will just existing company will join together. That's what it is about. So there is not much of difference. Both are same. Just that it depends on whether both are existing company or is there one alone joining with the other. Is that what matters? And acquisition is typically something like you are only purchasing shares. Let's say I'm purchasing 20% of shares in another company. I'm acquiring 20% ownership. So the acquisition is something like that. It has nothing to do with. For example, now Elon Musk is the new CEO of Twitter. He has acquired Twitter by investing majority of he is the major shareholder right now. So that is acquisition. Yeah. So good. So we'll continue. So we'll continue to the next concept. The next concept is charging section. Charging section. Whenever we said Income Tax Act is generally requires a charging section. Requires a charging section to tax something, to charge something as an income, to tax something. What is very important is a charging section. Now, we said in salary it is 15, and then in PGBP we said it is 28. In capital gain it is section 45. So section 45 is what is capital gain is about. So capital gains charging section is section 45. What does it say? It says any profit or gains arising from a transfer of a capital asset. We have already discussed what is a capital asset. We have also discussed what is a transfer. So now this capital asset and transfer has been defined. So when there is a transfer of a capital asset affected in the previous year, okay, so it should have happened in the previous year, shall be chargeable to income tax under that capital gains in the previous year, in which the transfer took place. So it's not any other year. If this year you're transferring, it is taxable this year. If you're transferring this year, it is taxable this year. So that's what it is about. So the year of transfer and year of taxability is same. So any profit or gains arising from a transfer of capital asset affected in the previous year shall be chargeable to income tax. Now, we were stressing on this concept, right? Previous year transferred, previous year taxed. The same year it is transferred, the same year is taxed. But in some cases it varies. Okay. So there are exceptions to this concept of previous year transferred, previous year taxed. So same year in which it's transferred, same year in which it is taxed. There are exceptions to this. The first exception is insurance receipt. So insurance receipt is the first exception. It says when a person receives any money or other asset. What do you mean by other asset? Let's say there was a machinery that got damaged or due to fire. Now insurance is replacing me with another machinery. So it is other asset. So either they could give you cash for that machinery, you could do anything with that, or insurance company itself could give you another asset. That is what is there. So you have insured that asset. Remember PGBP, what is the purpose for which you can insure a particular asset? Damage or destruction. So if there is any damage or destruction for which insurance company is giving you money, that money or is giving you an asset, or that asset will be treated as profit or gains in the previous year in which it was received. So whatever money was received or whatever equivalent money based on the asset received will be taxed not in the year of damage, but in the year of receipt. If you actually see, damage or destruction is also a transfer. Why? Because damage or destruction results in loss of rights. So it is a transfer, but it is not taxed in the year of transfer, but in the year in which you are receiving money from the insurance receipt. So when you say damage or destruction, we have been stressing on this word damage or destruction. What do you mean by damage or destruction? We keep speaking that in PGBP. We said for in section 30 for building, insurance is allowed provided it is for damage or destruction of building. Similarly, in section 31, insurance is allowed for plant or machinery and furniture provided the insurance is for damage or destruction. In section 36, insurance premium paid on stock is allowed provided the insurance on stock is for damage or destruction. Everywhere we said damage or destruction, but we never understood what exactly is meant by damage or destruction. We'll see that now. The first one is damage or destruction means natural disaster through a flood, cyclone, earthquake, or something like that. So it's a natural disaster which affects the particular your asset or whatever it is. Is called first scenario. That is a damage or destruction. Second scenario is some riot or civil disturbances, which means there is some clash in the roads. We see these strikes, right? Political reasons why there is a strike. If someone ends up opening their shop on that particular day, there could be damage or something because of this riot. So riot or civil disturbance is because of internal disturbances, which results in damage of your asset. So that is riot or civil disturbances. Then accident, fire or explosion. We keep seeing this several times across the news and other things. We see that fire came up in this factory, that factory damaged so much of goods and all. So that accidental fire or explosion is also that money for an asset is also a capital asset, is also because called as damage or destruction. Finally, action by way of enemy. There is nothing, no riot, civil disturbance and all, but I have an enemy who's not happy because I'm doing good in my business. Suddenly in the night or something, he comes and tries to attack me and damages my property. So this is a specific attack. When you say riot or civil disturbances, it's a general attack. But when you talk about the last one, action by an enemy or action in combating an enemy, it becomes like a basically called as a damage or destruction. So these things is what is basically called as damage to or destruction of any capital asset. So insurance receipts on capital assets, on receipts of capital asset, which is damage or destruction has happened for these reasons, then that receipt is taxable only in the year of receipt, and not in the year of actual damage or destruction. So how do we understand this? So for this also, we need to know what is the period of holding, what is the year of consideration, everything. So we will understand that the property is purchased on 12th June 2018 for how much? 7 lakhs. So property is purchased. Now there is an accidental explosion, something like fire, something has happened. So on 10th May 2021, this has happened. So that asset, whatever asset that we are talking about, let's take it's a machinery. Okay, let's take it is a machinery. So now this machinery, insurance gives the assessee a new machinery on 16th May 2022. The fair market value of that asset is 9 lakhs instead of 7 lakhs. Because his asset is actually 7 lakhs only, but what he has received is an asset worth 9 lakhs. Now, how do we compute this? So basically, the sale consideration is 9 lakhs, right? Whatever is the sale consideration is 9 lakhs. This capital gain from this transfer of this capital asset will be taxed in which year? Will be taxed in this year. That is previous year 22-23 and not 21-22. So not in the year of damage or destruction, but in the year in which the insurance provider provides you that alternate asset. So how do you compute? You take the selling price, that is 9 lakhs, because as per 45(1)(a), the fair market value in case of asset. In case of money, that money. If it is another asset, the fair market value of that asset. So you take 9 lakhs, you reduce the cost. We'll see about this concept of index cost of acquisition a little later. But the importance here is period of holding. Period of holding, should it be from 18 to 22 or 18 to 21? The period of holding should be from 18 to 21 and not 22. So the whatever is the index cost of acquisition is basically you take this total value divided by 280, that is the property purchased here, into it must be only taken till it is damaged. So it is only taken till that period. So you should ignore the year of things. The year till which is relevant is the year in which the explosion took place. So in the case of chargeability, the things we should remember is for sale consideration, whatever value of money received or the fair market value of that asset on the date of receipt of such asset. So if you're receiving it on 16th May, the fair market value on that date is what is relevant. That is sale consideration. For transfer date, what date will be regarded as a transfer date? That's the sale date, the date of destruction. That is nothing but this date. Correct? So this date will be called as a date of transfer. So the period of holding and all will be considered till this transfer date only. From June 18 to May 21 is what will be considered. Okay. So I've just computed like a long term just to tell you like what it is there. So if it is a short term, you need not index and all. We'll see that a little later. Let me not confuse you. So basically, the point here we are trying to tell is when case of insurance receipt, the sale consideration is the money value or that you have received or the value of the asset that you have received. And the date relevant is the date of destruction is the transfer date. So the purchase date is the date you have purchased. The transfer date is the date of destruction. Depending upon that date, you decide whether it is short term or long term. Okay, we'll move on to the next exception. The next exception is stock in trade. So 45 provides that stock in trade is conversion, and section 2 clause 47. What section is this? Section 2 clause 47 defines transfer, correct? So it says that if it is a stock in trade, it shall not be treated as capital asset. So now we are going to talk about what happens when there is a conversion. So conversion or treatment of capital asset owned by a person into stock in trade. So he is having it as a capital asset, now being converted into capital asset. So he was owning a capital asset. Now it is being converted into a stock in trade. So it is no more a capital asset. So if a business carried on by shall be chargeable to tax in which such stock in trade is sold or transferred. So let's say I'm transferring it today. I'm transferring the capital asset as a stock in trade today, but I'm selling it 2 years later. So today is 26 November 2022. I am selling it in 2024. So that is the year in which you will have to treat capital gain. So you should not treat capital gain in the year of conversion. You should treat it in the year of finally selling it. Why? I told you why is important, right? Why? Because if you try to remember this as a provision, it is very difficult. Just try to remember it as a reason why this provision would have come in place. Now, moment you say capital gain in both these provisions, not why for this alone, even for insurance, the why for both this insurance receipt and stock in trade, the why is same. The why for 1A insurance, 2 stock. Okay. to stock. Y in the year of receipt. Y not in the year of Y not when damaged or converted. Why can't you treat it in this period itself? Why can't you treat it in this period itself? Why are you treating it as an income in the year of receipt? Why? The reason is, see, in the year of damage, do you have the money to pay capital gain? Do you have the money to pay? In case if you have to pay capital gain, will you have the money? Will you have the money to pay capital gain? No. And will you know how much you are going to receive? Being insurance, will you know how much is going to be your sale consideration? What exactly will you have be the sale consideration? So you do not know sale consideration is a question mark. So you do not know how much is the sale consideration. For insurance, you do not know how much is the sale consideration. For stock, you don't have money. So you don't have money. So for these reasons, so how will I pay when I don't have money? How will I pay tax when I don't have money? How will I pay tax when I don't know what exactly is my sale consideration? So this is why these things like insurance receipt or be it your stock conversion is considered in the year of receipt, in the year of, that's why we say sold or transferred. Why? Because when you're finally selling it, when you're selling that stock in trade, you get the money. With that, you will pay income tax on capital gain to support you. The income tax is framed in this manner. So the sale or transfer of stock in trade converted from a capital gains will give rise to income chargeable as capital gain and business income. So in this conversion, you'll have both the income. One part will be called as capital gain, another part will be called as business income. How do you do that? So for capital gain, fair market value on the date of conversion, will be your sale consideration. Fair market value on the date of consideration, and the date of conversion minus cost of capital asset. So whatever is your cost is the capital asset. Indexation will be taken only till the period of conversion. So like your damage or destruction, indexation is done only till the year of damage or destruction. Similarly, here also indexation is done only till the year of conversion, not till the year of final sales. Gain recognized in the year of sale of stock. Okay. Now, whatever is the sale value minus the fair market value will be the business profit. So the cost for business profits will be the fair market value. Okay, that's what it is about. So now sale minus fair market value. We'll see this as an example. So we'll take the same concept of vehicle purchased on 12th June 18. It has been purchased for 7 lakhs. It is converted to stock. On 10th May 2021 when fair market value is 9 lakhs. Now finally it is sold on 16th May 2022 at 12 lakhs. So now how do you compute? So typically there is one portion called capital gain, another portion called what? Another portion called business profit. So what is capital gain? For capital gain, we need to know what is the sale consideration. Sale consideration, the provision provides fair market value of that particular stock on the date of conversion will be your fair market value. Similar to insurance receipt, fair market value on the date of receipt of the asset. So here it is fair market value on the date of conversion. So it is 9 lakhs. So you take 9 lakhs the sale consideration. What is the cost? Cost is basically 7 lakhs. If you want to index, if you need to index, provision says take only till the conversion date. So you'll have to index based on this number and not based on this number. So that's how you basically work out this problem. So selling price is this. You index it only based on 280 and 370 and not on whatever. If some of you are having doubt on indexation, please hold on. We'll cover it a little later. So now this is capital gain. So this is capital gain. This is PGBP. What is PGBP? 12 minus 9 lakhs. 12 lakh is this. 12 lakh is your sale of stock value. Whatever is the sale receipt, that is your revenue receipt. So this is revenue receipt, correct? So hence treated as your business income. So 12 minus 9 lakhs. This 9 conversion will be called as your capital, kind of your capital concept. So this 9 lakhs is becomes your cost. So the 9 lakhs becomes cost of the asset. So 12 minus 9 becomes 3 lakhs. So 3 lakh is PGPP, and the first part will be called as capital gain. So any doubt on these two things? Riot or civil distance also covers 2611 Taj attack. Yes, of course, Abdul, yeah, right. And even the last one, which said enmity, it also gets covered in that also. Vashishta, I think I've answered part of PGPP, which is PGPP and which is capital gain. I think I've solved it with that example. Dhyanesh, CAA's capital indexation, we'll see that cost inflation index. It is called cost inflation index. Please hold on to it right now. We'll see that in the subsequent session. Sir, it is capital gain of previous year turn, which is gets registered, or previous year 23, in which Rashmin Kumar, see, the capital gain will be taxed in the year of receipt from insurance company. So it will be taxed in previous year 22-23. It will not be taxed in the year previous year 2021. Why? Because in the year thing, you do not know what is the sale consideration. What is the sale consideration? The insurance receipt. You do not know how much is insurance, how much will be the insurance receipt. After destruction, there will be a valuation. Someone will come and assess, finally arrive at the number. After arriving at the number, they will give you a new asset or a money. So you do not know how much is sale consideration. So you will treat it in the year of receipt. Abdul, how you calculate capital gain? Because vehicle is personal asset. If a vehicle is a personal asset, then it is not taxed. We are thinking that it is a business asset. Vedant Thora, in this part, stock in trade, we have to only learn that what part is capital gain, what is business. Correct, yeah. As far as this stock in trade, you need to know to differentiate between business income and capital gain income. Capital gain, for both of the things, the common point is fair market value. For both of the things, common is fair market value. Why? It's just erase this for you to have a clear reading of it. Yeah. So, sale consideration will be the fair market value on the date of conversion to stock. So, this is the common point. Here it is fair market value. There, here it is sale consideration. For capital gain, that becomes a sale consideration. For business, that becomes a cost. That becomes a purchase cost. So transfer date is equal to, so for capital gain, it is sale consideration. For PGBP, it is purchase cost. Correct? Purchase cost. So the FME that we are talking about, for capital gain, that becomes a sale consideration. For PGBP, that becomes the cost. Transfer date will be the date of conversion or transfer. So that is why we are only considering it this year. So as if it is being held only till that period. And the charging year, when will it be charged to income tax? In the year in which it is finally sold. So the final year of sold is 16th May 2022. So it will be taxable to capital gain and business. Both it will be taxed only in the previous year 22-23. 54 EC. We will see that later. It is an exemption. You need to calculate 6 months from the date of transfer of asset. But here it is 6 months from the date of sale of stock. If some of you are not, we will see this a little later when we are covering it in exemption. So as of now, let this be there in this slide. I'll explain you specifically once you understand 54 EC. So for now, what do you need to understand? For calculation of 6 months, it is from date of sale of stock, not date of transfer of asset. Vashishta, insurance is also covered in PGBP. How do we differentiate between PGBP or capital gain? I'll make it very simple. What is discussed in PGBP is insurance premium payment. payment, it's an expenditure. What we discussed in section 30, 31, 36 are payments. It is what is being paid to the insurance agent, the premium payment. But here we are talking about receipts. We are talking about receipts. So once it's payments, we are discussing it in PGBP. Once it is receipts, we are talking about in capital gain chapter. Okay, so we'll move on to the next concept. Next concept is compensation on compulsory acquisition. We already discussed about compulsory acquisition, right? We said compulsory acquisition is basically what? We spoke about an example of metro construction, where we said metro construction is happening across the country, where we said there might be a requirement where government needs a particular land. So government has complete rights in taking over your property, provided they settle you with some money. Now let's say I have a property in Chennai. Let's assume the property stamp duty value. What is stamp duty value? It is called as guideline value, which is basically the value determined by the government. Let's say the value of that property is 60 lakhs. Okay. Market value. Market value is 95 lakhs. Market value is 95 lakhs. Now, my property is required by the government. So, government wants to acquire my property. I cannot say no. But government is settling somewhere in between. Government settles 80 lakhs. Okay, government settle 80 lakhs. Now, whatever I received from government, 80 lakh is my sale consideration. I'm selling that property. I'm selling that property I'm transferring to government. So 80 lakh minus whatever cost when I acquired, I do capital gain working, I do it. Okay, now. But I am not okay, not satisfied. Okay, so basically, I am not satisfied. I'm not satisfied because why? Because I have received less money. Instead of 95 lakhs, I am only getting 80 lakhs. I am not okay. So I am appealing. I appeal to government, or there is also a process in court. So I go through this and say, I need more money. See, the current market value is 95 lakhs. If I had sold it to someone, I would have sold it to 95 lakhs, not at 80 lakhs. So why don't you compensate me? Why don't you compensate me on this whatever compulsory acquisition? So this 80 lakh is actually the compensation I am demanding. So I demand 15 lakhs extra. So there is a process. After that process, I am receiving it. Finally, court says, yes, he is perfect. He is perfectly right. If he had sold it outside, he would have sold it for 95 lakhs. It's not right for you to give 80 lakhs. Give him additional 15 lakhs. So this is called enhanced compensation. This is called enhanced compensation. So what I received 80 would have already been taxed in that year. Let's say we'll also talk about a year. This period, this 80 lakhs, this transaction happened in financial year 2018-19. Okay. So for that financial year 18-19, I would have reported capital gain with 80 lakhs. I would have reported capital gain with 80 lakh as my sale consideration. But subsequently, I am getting this enhanced compensation. It is chargeable in the year of receipt. Why? Why? Go back to what I said. Do you know how much enhanced compensation you are going to receive? You know that 95 is there, but do you know that government will give you 15 lakhs? Do you think government is that much, happy about giving you more money? No, right? So government may not be happy giving you the extra 15 lakhs. They may settle for 5 lakhs, 6 lakhs. We never know. So I will not know the amount. So I will tax it in the year of receipt. Please understand why. When you know the transaction, if you actually think at it, you will know why it is being taxed in the year of receipt. not, let's say the year of receipt is this year, that is financial year 22-23. You will know why it is taxed in 22-23 and not in 18-19. Why? Because in 18-19, I don't know that I will receive 10 or 15 lakh extra. I don't know when I will receive. I don't know how much. I don't know when. Then how will I pay tax? That's the very reason why we are actually calling it as in the year of receipt. So all what we have been discussing about insurance, stock, now this compulsory acquisition, everywhere we do not know either the sale consideration or we do not know, we don't have money right now. We will receive it only later. Only for these reasons, we are taxing it in the year of receipt. Now, in this case, what will be the cost of acquisition? When I already filed in previous year 18-19, I would have treated the entire cost. I would not hold any cost. Whatever was my cost, I would have included that. So now, when I'm actually receiving it, let's say this demand is received now in financial year 22-23. So now in this 22-23, my cost will be nil. Why? Because it is already included in financial year 18-19. That's why the enhanced cost will be treated as nil. Please understand, in every provision, if you understand this why, you will know, you will be able to remember and keep it forever. The simple thing is understanding the why. Understand the why, you will definitely have a complete grip on the subject. And now, when they give this enhanced compensation, in previous year 22, for this period, they will also pay interest. For this period, between this period, that is 18-19 and financial year 22-23. For this period, not just 15 lakhs, they'll also give you interest. Why? Had they given that 15 lakhs in that year itself, I would have invested, right? So they are delaying me the payment, so they'll have to pay it with interest. That interest is taxable. Only 50% of that interest is taxable under income from other sources. So this will be covered under income from other sources. So this is IFOS. Okay. So income from other sources. So this is about enhanced compensation. Now we said in the year of receipt, correct? But there's a small twist here. What if there is an interim order? So we said financial year 22-23. What if the order passed was in financial year 21-22? Once order was passed, compensation received in possible interim order. So now there is an order. In that case, it will be taxable in the year in which order is made. So now the order is made in financial year 21-22. That is the year of taxability, not the year of receipt. So if it is, why? Again, why? Because now you know how much is going to be taxable. So you can actually put it and tax it about. So that's what it is about. Final order is made. So if it is an order based, you tax it in the year of final order. If it is not an order, you tax it in the year of receipt. In case if the person is passed away, the person who is supposed to receive this enhanced compensation is no more. It will be taxed in the hands of the person who receives. We are not talking about legal heir, nothing. The person who receives that money will be needs to pay tax on that. And recomputation shall be done by way of rectification. What do you mean by reduced compensation? Now you have received 15 lakhs. You have received 15 lakhs in previous year 22-23. Okay. After 2 years. Now, in financial year 23-24, the assessing officer, now it feels that it is not 15 lakhs. Government has gone and appeal. Okay, you have received 15 lakhs. Government has now gone and appeal and say it is not 15, it is only 10 lakhs. So in this case, we are reducing, right? We are reducing it. So if there is anything that reduction needs to be done, the recomputation shall be done by the assessing officer. So for that year, whichever year I would have filed my return, in financial year 22-23, I would have filed my return reporting 15 lakhs. But in 23-24, I realized it is not 15 lakhs, it is 10 lakhs. So I file a petition before. I file a petition before, rectification petition before the assessing officer. And say, see, I by mistake or not by mistake, I was told that it is 15 lakhs, but now they are saying me it is only 10 lakhs. So please reduce 5 lakhs from my income and refund me the tax extra paid on that. So this is called reduction. So enhanced is taxable in the year of receipt, but if it is through an order, it is taxable in the year of final order. If the actual owner is no more, then the death of transferor, in case of recipient, whoever is receiving the money needs to pay tax on that. In a situation where the enhanced compensation is subsequently reduced, you will have to file a petition before the assessing officer and claim the refund. These are all very logical. Just think what you will do. You have paid higher income, you have paid higher taxes. Now you know that you have to reduce that income. What do? You appeal before the assessing officer saying that now it has to be reduced. So these are the concept of compulsory accusation. So I'll see if there are any questions on compulsory accusation. I think all of you are very clear. I think I'm explaining it very detailed, right? Because I see less questions today. Looks like either I have been explaining it very clearly so that none of you have any doubts on that, or maybe it's a situation where all of you are not understanding anything. Either of this only could be the possible scenario. So either I'm very good or I'm too bad. I don't know what exactly I am. So I hope I'm actually making it clear by also telling you why the provisions have come in place. So now, since there are no more questions, we'll move on to understand to the next concept. So we are still in the concept of what? 45 is a charging section, but there are exceptions to it. In some cases, it is taxable only in the year of receipt. It is taxable in a different year. We saw insurance, we saw stock, then we saw enhanced compensation. Now, the next thing we are going to talk about is joint development agreement. If you actually recollect, sometime back, when we were talking about this concept of transfer, okay? Transfer, we said part performance contract. Part performance contract is also taxable. So generally, part performance contract is, now I give the right, I have a building. We'll take an example. I have a property. When I say property, I'll write it as building itself. So I have a building, okay, of let's say 2,400 square feet. Okay, I have this building. With 2,400 square feet. Now this building, I have decided I'll demolish the building right now. What I have, I will enter into an agreement with the builder. So I will demolish building. So that's the first step. I'll leave that. So I enter into an agreement with builder. So what happens? I tell the builder, so you build flats. So now what is the builder buying? Builder is actually buying this 2,400 square feet of land and a building top on it. Then it will be demolished and built as flat. Now, how will I be compensated? Me, okay? So how will I be compensated? Because at the time of builder agreement, builder will not settle me money. He will settle me now and then when the flat is built. He might be giving me some cash. He might be giving me some flat. There might be an agreement where he says, I will build, let's say he's building 16 flats. He says, 4 is yours, 4 for me, 12 for him. Okay. So whatever my revenue is this 4. Whatever I get is this equivalent value of this 4 flats is what is my total sale value. So now please understand, I'm giving my land, I'm letting the builder build. Now the builder builds 16 flats. He says 4 is yours, 12 is mine. Now this 4, I can keep it for myself or sell it to someone. But the cost of this 4, the value of this 4 flat is only my sale consideration. That is only my compensation. So now I will not know this in the first year. Like let's say I enter into this builder agreement on, let's say I enter into this builder agreement in 2019. So I don't know in 2019, I don't know how much I'm actually going to receive. So I enter into an amount and all, but I will not receive it. I'll receive it later only. When will I receive it? Only when probably he starts selling this 12 flats. Correct? Let's say he has to give me 2 crores. When he starts selling this 12 flats, he starts giving it to me. So there is a delay, right? If government wants me to pay tax in financial year 18-19, it is very difficult because I don't have money. Because it is not settled. So for this reason, what government says is, in order to minimize the genuine hardship in joint development agreements, because joint development agreements are entered in 1 year, but revenue generation happens in future. So it says, basically, the first condition is an individual or HUF enters into a specified agreement for a project. In such cases, capital gains shall be chargeable in the previous year in which the certificate of completion for the whole or part of the project. Please understand, whole or part of the project is issued by the competent authority. So what is certificate of completion? Certificate of completion is a period where that corporation authority, the authority responsible for buildings in that particular city or locality, will have to approve, say that this is ready for occupation. So this is called certificate of completion. Only then people can come and start occupying that building. In our case, we were talking about 16 flats. Only when we get certificate of completion, the owners of 16 flats can come and start residing there. So that is what is called a certificate of completion. Now, it has to be taxed in that year in which certificate of completion is received. But there is another condition where, in case if the property sold before that, where the assessee transfers his share in the project on or before the date of issue of completion. Now let's say this 4 flats plus 12 flats, 16 flats, certificate of completion, okay, is happening in financial year 23-24. 23-24 only I'll get certificate of completion. But I am selling this 4 flats in financial year 22-23. Even this 12 flat, the registration of land and all is happening. So this is happening in 22-23. So I'm finally transferring it to someone, or I'm receiving money in 22-23 itself. Then what happens is it will be taxed in 22-23. So it will be taxed in the year which such transfer takes place. So for this 4 flats, if I'm selling in 22-23, I need to pay tax to that extent in that financial year 22-23. So what will be the sale consideration is nothing but stamp duty value of that property, that is 2,400 square feet. 2,400 square feet plus cash received. Whatever cash has been received will be the sale consideration for that entire property. So this is how you basically, so what will be the sale consideration? The stamp duty value on the date of completion plus cash received is what will be treated as the your sale consideration. So if say we said this guy will give me 4 flats, so what is my compensation? I will receive 4 flats, okay, instead of this. So I will take the stamp duty value of 2,400 square feet plus, let's say he's giving me 15 lakhs. So this will be my total amount, total sale consideration. Whatever my cost will remain the same. So my sale consideration will be the stamp duty value of this 2,400 square feet plus he is giving me 15 lakhs. That will be my, let's say this is 80 lakhs. So this will be 95 lakhs. So my sale consideration is 95 lakhs minus cost, all that whatever we take will be considered. So this is what is about your joint development agreement. So this is introduced to because of genuine hardship causing to the persons entering into joint development agreement. So they are letting them recognize capital gain in the year of completion certificate or in the year of transfer, whichever is earlier. So if you have to remember, you can remember it as certificate of completion transfer whichever is earlier. So whichever is earlier will be a date in which you'll have to recognize the capital gain. So that's the thing. So certificate of completion or this transfer is what will be considered as your capital gain point. So capital gain will be taxed in the certificate of completion year or transfer year, whichever is earlier. Okay. So with that, we have completed all section 45. So what did we discuss in section 45? We said section 45 is a charging section for capital gain. It will be taxed in the previous year in which the asset is transferred. It will be taxed in the year in which the asset is transferred. But there are some exceptions to it. For example, insurance, where it is taxed in the year of receipt based on the value or fair market value of the money received. And similarly, for stock in trade, it will be recognized in the year in which the asset is finally sold. The PGBP will be recognized. The sale of stock is the year in which capital gain will also be recognized. So partly capital gain till the date of conversion, then it is PGBP. Then we saw enhanced compensation, where we said whatever is enhanced compensation will be taxed in the year of receipt. Cost will be nil. And then if it is interim order, then the order date is what is relevant for taxability. If the person has passed away, the recipient will be taxed. If subsequently it is reduced, you need to apply to the assessing officer to get the refund or reduce your income. So that is what we discussed. And then we discussed about this joint development agreement, where when an assessee is entering into a joint development agreement, that is individual or HUF, it is taxed in the year in which certificate of completion or the asset is transferred, share is transferred. In that year, it will be taxed. Whichever is earlier, it will be taxed. So what will be the sale consideration? It will be your stamp duty value on the date on issue of completion or the cash receipt, whichever is earlier. So that is about it. So that's all about section 45. So we'll move on to the next section, section 46. Shivlani, yeah, for the question is whether for builder will it be charged in PGBP? Of course, because builder's income itself is construction, so it will be taxed in PGBP. Vedandora, I have not left specified agreement. The concept of joint development agreement only specified agreement. For whoever is reading the words in the material, joint development agreement is called a specified agreement. Now, what is that specified agreement? I already explained. Maybe I'll explain you again. I told you through this diagram, right? So, as a building, I enter an agreement with builder. What am I doing? I'm entering into an agreement with this builder. So, me entering into an agreement with builder is called specified agreement. What does that agreement talk about? That you need to build flat, how much you need to give me, when you will give me, all the timelines, everything is called a specified agreement. So I have not left it. I have explained it as part of this drawing. So that's where you have to correlate. So this study material defines specified agreement. That is nothing but an agreement entered between me and this builders for the purpose of this. So that is what is basically called as joint development. Me, in my land, a builder is building. In my land, a builder is building. This is called joint builder agreement. So that is what is called a specified agreement. So Hora, I have not left it. I've explained it through that diagram. I did not use the word specified agreement. Rather, I used the word joint development agreement. Okay. Thank you, Hora and Dhyanesh, for saying that the session is really helpful. Thanks for that compliment. Okay, we'll move on to the next concept of 46, where it is about distribution and liquidation. That is section 46. So section 46 is typically what you call A company where the assets of company are distributed to shareholder in liquidation. So we're going to talk about liquidation. So what is liquidation? We saw earlier, it is like winding up. It is shutting down the company. So now, how do you settle? How do you settle during liquidation? Sometimes you either give the asset itself to shareholder or you sell the asset and then distribute the money. Now we are going to talk about when the assets are directly distributed. So when the assets are directly distributed, when the assets of a company are distributed to shareholders to liquidation, such distribution shall not be regarded as transfer by the company. So it is not a transfer to them. So it will not be a transfer in their hands. It is only when the asset is directly distributed. If the asset is first sold, out of that money it is distributed, then it is applicable. What is not applicable? What is not applicable is asset directly selling to the shareholder. So this is from the company's angle. What about shareholders' angle? So we say it is not a transfer to company, so it is not taxable under capital gain to transfer. As far as your shareholders, the first concept is deemed dividend. One portion of the distribution will be considered as deemed dividend. That is to the extent of accumulated profit. To the extent of accumulated profit, that distribution will be considered as deemed dividend and will be taxable as income from other sources. So distribution to the extent of accumulated profit will be considered as dividend. Why? Why? It's very simple reason. Any distribution from profit is dividend. Any distribution from profit is dividend. Okay. Now let's say the company has profit of 10 lakhs. Okay. And shareholders, let's say me, I own 1,000 shares out of 10,000 shares. So total is 10,000 shares. I own 1,000 shares. Now, out of this 10 lakhs, generally what happens to profit? It may be distributed as dividend. So if they're distributing it as dividend, I'll get what? Dividend per share will be what? Like 100 per share, right? 100 per share. Am I right? Yeah, 100 per share. So what will I be receiving? What will be I receiving? I will be receiving rupees for 1,000 share into 100. I will receive how much? 10,000, 1 lakh. I will receive 1 lakh. So this 1 lakh is if I receive, it will be treated under income from other sources. Now let's say the company is winding up. They're completely settling the whatever it is. Now let's say company is settling 30 lakhs. Okay. Settling 30 lakhs. Okay. So for that, 30 lakhs for me, 30 lakhs me share will be how much? Will be for 1,000 shares, right? For 1,000 shares. So instead of 10 lakhs, they're going to settle 30 lakhs. So 30 lakhs, 10,000 will be how much? 1, 2, 3, 4, 300 into 1,000, right? So 3 lakhs if I'm right. So my share in this will be 3 lakhs. So this 3 lakh, now what is happening is they're giving in an equivalent asset. Asset value 3 lakhs. Okay, asset value of 3 lakhs. Now this asset, whatever I'm being considered as whatever I've received is worth 3 lakhs. Out of the 3 lakh, I'm going to talk about it as this portion 1 lakh will come under IFOs. Balance 2 lakhs is capital gain. So to the extent of accumulated profit, because my profit is already 10 lakhs. So in case if they have distributed as dividend, I would have received 1 lakh. So that 1 lakh will be considered as dividend because it is appropriation of profit. So it will be considered as dividend, whereas the balance will be considered as my capital gain. So we'll go back to this. So now, as we all know, the balance will be capital gain. So the full value of consideration will nothing be money is received plus fair market value of assets. So in this case, whatever we saw, money is received is 0, fair market value of asset is 3 lakh. Fair market value of asset distributed is 3 lakh minus deemed dividend under section 222C. So deemed dividend is 1 lakh. So in our example, money is received, money plus FMV minus dividend, correct? So my money is 0, fair market value of the asset is 3 lakhs, minus dividend value is 1 lakh. So 2 lakh will be my sale consideration. So 2 lakh will be my sale consideration. So that is what it is about, right? So money is received 0, fair market value is 3 lakh, minus deemed dividend is 1 lakh. So capital gain 2 lakhs. Capital gain, that is sale consideration, not capital gain. Sale consideration for capital gain is 2 lakhs, whereas your dividend for income from other sources is 1 lakh. So that is about distribution and liquidation. Clear? So we'll move on to the next concept, buyback. So your liquidation is 46, buyback is 46A section. So what is 46A saying? So it is characterizing this buyback as shares of domestic company, other shares, other securities. Shares of domestic company, other shares, other securities. How do you tax it? In the hands of company, if it is shares of domestic company, it is taxable under section 115QA at the rate of 20% plus applicable surcharge and cess. The surcharge applicable is 12%. It's not like what is applicable for company and all. It is a flat surcharge of 12%. So 20% plus surcharge 12% plus cess 4% will what be taxed for companies. It will be taxed in the hands of company. Since it is taxed in the hands of company, you can't double tax it. So it is exempt in the hands of the shareholder, or it is exempt in the hands of shareholder. So this is for what? Shares of a domestic company. So in the hands of company, it is taxable at the end of 20% plus 12% surcharge and 4% cess. So what will be the tax rate? 20%. So it is nothing but 23.296%. So for company, they will pay tax at 23.296%, whereas for shareholder, it is exempt under section 10, clause 34. So that is for share of domestic company. It could be listed, it could be unlisted. It is shares of domestic company. What about other shares? It is not taxed in the company's hand. For other shares and securities, it is not subject to tax in the hands of companies. Instead, it is taxed in the hands of shareholders in the concept of capital gain under section 46A. For both this 115QA and for capital gain, how do you represent this income? So it could be a capital gain under section 46A or an income under section 115QA. How do you compute? The capital gain shall be sale consideration minus cost of acquisition. It is that simple. Any capital gain is sale consideration minus cost of acquisition. What is sale consideration here? It is consideration received by the shareholder or the holder of that specified security. That is the money received by the company. If a company is buying back shares from me, company will pay me. So whatever money I have received it from my company, that money is what will be considered as a sale consideration minus cost of acquisition. Is paid by shareholder to buy such shares. So whatever I'm receiving from company is my sale consideration. Whatever I would have paid at the time of purchasing the shares is my cost of acquisition. So sale consideration is what is received by the shareholder. Cost is what is paid by the shareholder to the company. So that is about sale consideration minus cost of acquisition. So what are we saying is we are talking about buyback. So shares of domestic company. What is domestic company? A company incorporated in India under the Indian Companies Act 1956 or now Indian Companies Act 2013. And the domestic company also includes company which is a foreign establishment in India, foreign company in India that is declaring dividend. So foreign company in India that is proposing dividend. So that is also called as domestic company. So typically we'll keep it as we'll even leave that foreign company that because that will be called as an Indian. So domestic company is a company which is being incorporated under Indian Companies Act 1956 or Indian Companies Act 2030. For them, it will be taxed under 20% plus 12% surcharge plus 4% cess. That is tax in the hands of company. Correct? That's why it is exempt in the hands of shareholder. Whereas for other shares or security, it is taxable in the hands of your shareholder. So it is taxable in the hands of shareholder and exempt in the hands of company. It's very clear. Now, how do you treat the sale consideration? It is nothing but received by company. Received by shareholder. Received by shareholder. This is your sale consideration. And paid by shareholder. Paid by shareholder is what? Is your cost. So this minus this is your capital gain. So that's all about your buyback of shares. So when do buyback generally happen? If you want me to give a brief thing about buyback of shares, if you want me to just brief me about buyback of shares, it is typically company at some point in time want to reduce the number of shares. Currently they have 10,000 shares. They want to reduce it. They want to reduce it by, let's say, 1,000 shares. That 1,000 shares will be purchased from various shareholders. So this is generally called as buyback. So Kavita, you want to know how did this 1 lakh came? Okay, I'll explain this liquidation again. See, liquidation is winding up of a company. Let's assume there is a company which has a profit of 10 lakhs, and there are, so this is what I'm saying, which has a profit of 10 lakhs. This is profit, okay? So, and there are shareholders, total number of shareholders, total shareholders. This is what I own. I own 1,000, total shares is 10,000. So 1,000 divided by 10,000, 10% is my proportion of shareholding. So out of 10 lakhs, I'll be eligible for 1 lakh. So if the company is continuing, assuming the company is continuing, they would have given me, in case if they wanted to distribute the entire profit as dividend, I'm just assuming, okay, for the purpose of explaining, they would have given me how much? 1 lakh as profits, 1 lakh as dividend. Correct? So that would have been taxed under income from other sources. Clear? Now they are not distributing my 10 lakhs. They are winding up. They are closing up. After closing up, total money they are getting is 30 lakhs. Total money that company is getting is 30 lakhs based on liquidation. Their value, their net worth is 30 lakhs. Now this 30 lakhs will be distributed to the shareholders. So totally 1 lakh shareholders. So my share is 3 lakh. My share of income is 3 lakhs. So what is happening? This 30 lakhs divided by 3 lakhs. The 30 lakhs, out of that, my share is 3 lakhs. Now, to the extent of profits, so in 3 lakhs, in this 3 lakh, 1 lakh is profit, balance is capital gain. 1 lakh is profit, balance is capital gain. So this 1 lakh, where did this 1 lakh come? It came from here. It is like from accumulated profit, because the company's accumulated profit is 10,000. So this 1 lakh will be taxed under IFOs, balance will be taxed under capital gain. So that's how this 1 lakh came. So I think now, Kavita, you are clear with buyback of, liquidation of shares. Abdul, foreign company holding by Indian company is domestic company? No. Domestic company is a company which is incorporated under Indian Companies Act 1956 or Indian Companies Act 2013. So they are only called as a domestic company. There is another definition called Indian company. I'll not take you through that right now. So as far as domestic company is there, that is what it is. Shivlani, in case of a enhance 80 lakhs received in the year of sale will be taxed in the year, and if any received, I think I answered you, Shivlani. Your answer is correct. So 80 lakh would have been taxed in our example of whatever we wrote somewhere. Where did we write here? Yeah, 80 lakh will be taxed in the year 1890, and balance 15 lakhs only will be taxed in 22-23. So your understanding is correct. Rama, if share offer price is 5 and issued or face value is rupees 10, in that case, buyback, there is no capital gain share. Correct. So in that case, it will be a loss. Let's say there is no accumulated profit, there will only be a loss. Still, it will be covered under capital gain. It will be covered under capital gain, but at a loss. So this sale minus cost will result in negative in that case. Will result in a negative number. So that is what you actually call it as, you call it as by loss. It is not a capital gain, it is a loss from capital gain. So there will be no capital gain, but a capital loss still needs to be reported under capital gain. It's like profit and gains. Both profit and loss is covered there. So with that, I think I've covered it for today. I think I've answered all the questions also. So thank you for the wonderful session. We will see in the next session on the balance capital, the rest of the capital gain. 4 sessions are capital gain. So today is the first session. So we'll continue with capital gain and understand the computation of capital gain in the next session. So thank you for the wonderful session.